We've been involved in the hybrid market sort of pretty much since its infancy in Australia. And really it's a market which is basically a subordinated market, heavily subordinated. One of the challenges, however, it's only one part of a broad opportunity set. So as I've spoken about, fixed income universe is basically bigger than global equity markets. Hybrids is one component of that, and it can perform a certain role in the portfolio, but I think it's not without its risks, and it shouldn't be held to the exclusion of other assets. Hybrids have really been like a mainstay of retail investors that previously have had limited access to markets. So typically you used to be able to buy term deposit equities and hybrids, and the vast majority of the rest of the fixed income market was unavailable. So I could go and buy a penny dreadful mining stock, but I couldn't buy a 5-year BHP bond and just click the coupon. Moving forward, that sort of pushed people into hybrids. It ticked some of the boxes, it gave you yield, it was listed so it was easy to access. The challenge is, however, that over the period of time, it's actually changed its spots quite significantly. So previously there was corporate and financial issuance, so it was relatively high quality, it was one step under debt, and it gave you additional risk premium. If you roll down now, there's not many non-financials in there, and for the financials, these instruments have become deeply subordinated, and the regulators have basically said next time we have a financial crisis, hybrid holders are going to basically share some of the pain. So the point of non-viability and a lot of those technical clauses actually mean that the volatility in hybrids, as we've seen in the past, is likely to increase. Now, we're not saying that you shouldn't hold them, but we'd say, first of all, you want to get paid for the risk. Second of all, you need to be aware of the concentration issues within the market, heavily financials. And third of all, you need to think about what else you need to hold into your portfolio, particularly to hedge it. So for example, we hold hybrids at the moment, but we don't really hold a lot of the listed ones. We prefer the wholesale tier 2, which are, for example, have a legal maturity of 10 years and can be called in 5 years. Importantly, we look at the risks and we can hedge some of that with duration, but also to currency. So I think the key point here really is that hybrids may form a role of client portfolios, but we're concerned that there's an over-reliance on that to the exclusion of other assets, which actually can assist investors meet their objectives without lumping too much risk in hybrids. Because we know that when equity markets sell off, historically hybrids have suffered. So when you have a situation where something which is supposed to look like a defensive fixed income asset can drop 15, 20%, to us that looks more like an equity investment. We're not saying don't hold it, you just need to know how it behaves and how much to hold and how you're going to manage the risk. Well, if you have a look at our portfolio at the moment, we've got less than 10% of hybrids in our portfolio. If you roll back sort of 5 years ago post GFC, it was higher, and even pre the GFC it was higher again. So our view at the moment is that we've sort of have been reducing our hybrid exposure, and we expect that to continue as the old deals roll off, if you like. Importantly, we've actually accessed a lot of the wholesale deals. So if you have a look at the listed tier 1 market, which is franked and typically the big 4 banks, that's one sub-segment, but we actually have preferred the tier 2 cash pay offshore securities. Bit technical there, but it's just highlighting the fact that simply going to the prospectus, jumping 200 pages and signing at the back to say, yes, I'll have X dollars worth of those, actually isn't managing portfolio risk, or is just buying an asset, partially because you might be familiar with it, but importantly, you typically may not understand the full risk. So in summary, we have held them in the past, we've been involved in the market for a long period of time, but our allocation has been reducing, we expect it to continue to reduce.